Hi, I'm Connor O'Brien, CEO of O'Shares ETFs, and today I'd like to talk about OGIG. That's the O'Shares Global Internet Giants. It's an index we developed and an ETF that we developed to own the world's largest fast-growing e-commerce and internet companies, most of which are, of course, in the United States. First, I'm going to tell you how we developed the index, then a bit about the research that is behind the index development. Then we'll talk about some of the industry subsectors that are in the portfolio of OGIG. And then finally, a comparison of really important data of OGIG compared to some other traditional older technology indexes. So let's take a look at the methodology. Start with over 2,000 global stocks, exclude all of them that are not in these e-commerce and internet services sectors. And then of those that are in, take a look at which ones have the right quality metrics and exclude those that do not meet the metrics for profitability and revenue growth. Of those that are in, that do qualify, then allocate capital or weighting to them based on their quality, their size, and their revenue growth score. And that, as a result, ends up putting more of the investor money in the companies that have the stronger metrics. Next, let's take a look at the research behind the methodology. We did a lot of research, and this conclusion might sound in the end to be common sense. What we found is that of stocks in this e-commerce and internet services categories, the companies with the strongest revenue growth had the strongest performance. And so you see here the first quartile ranked by revenue growth are the stocks that had over 40% annualized performance over that 3-year period. And it sounds like common sense. You want to own stocks with the strongest revenue growth. We wonder, why don't other people do it? We don't know. But we've done it this way because it's based on research that we believe is really, really helpful in indicating and selecting the stocks in these categories that will perform. Now let's take a look at the composition of the portfolio in the OGIG index. Here you see subsectors: internet conglomerates, 20% weighting; digital advertising, social media, a 9% weighting; retail e-commerce, 20%; digital entertainment, 7%; and enterprise software, the largest allocation in the portfolio, over 40%. The revenue growth is really important. The TTM, trailing 12-month column, shows you the actual revenue growth across each of these categories of the stocks within the OGIG index and ETF. Over 40% across each of these sectors. Look at the forward revenue growth. The average, bottom of that column, 42%. That's the revenue growth that we believe will really help drive the performance of these companies, their businesses, and their stocks. Look at some of the names here on the largest holdings. You recognize some of them, maybe not all of them. Amazon, Facebook, Meituan Jiangpang is a food delivery service, very fast growing in China, listed in Hong Kong. Roblox, digital entertainment, and Shopify is an example of a company identified very early by the OGIG process because it has such strong revenue growth. And now it's a stock that more and more people know as its market capitalization has grown to well over $100 billion. Now let's take a look at the portfolio difference when you look at OGIG compared to the NASDAQ 100 index compared to the tech sector index. We call these older indexes the old tech categories, and OGIG is new or newer tech. And the difference shows up in revenue growth. Look at the chart on the left. The OGIG index and its stocks have a 49% actual revenue growth rate. For the same period, the NASDAQ 100 stocks, an average 30% revenue growth, and for the tech sector, as it was defined in the olden days and still defined this way, is a 21% revenue growth rate. Well, what's the difference here? One of the differences in the tech sector index, the traditional definition, you have stocks like Intel, IBM, Cisco, good companies, important companies, although now growing much, much slower than those that are in the NASDAQ 100 and slower still than the ones that are in the OGIG index. In the NASDAQ 100, what you see is companies selected only from those that are listed on the NASDAQ. And they're not all tech companies, and they're not selected because they are fast growing or any of these other metrics that are research driven. They're just selected because they're listed there. So OGIG gives you a very different methodology designed to own the stocks with the higher revenue growth. If you take a look at the table on the right, you'll see how different OGIG is compared to the NASDAQ 100, 76% different, and compared to tech sector, 90% different. What that means is if you own the OGIG ETF, you get that much of your money owning stocks that are different than those you would get in each of these other two older technology indexes. Let us know if you would like additional information. If you're an advisor, send a note to info@oshares.com. If you're a self-directed investor, please take a look at our website, oshares.com. Lots and lots of research and other information there, or ask your advisor. And I would also invite people to register or subscribe on our YouTube channel so that you get notifications of future content releases and future research-driven video that we will be putting out. If you would like to register for our twice monthly webcasts, go to our website, oshares.com, and look for the registration button and register, and we will send you invitations to our live webcasts that are co-hosted at times by me, Kevin O'Leary, and often include a guest speaker that's a specialist in a certain topic. So thank you very much, and we look forward to speaking to you soon.